So today I want to start off with pointing out a mistake I made with calculating change in net working capital last class. So I misread the note on the cash flow statement. And this is changes in the assets and liabilities. Right, so what I calculated here is basically a change of change. So we're going to start with fixing this error, and that's going to result in some different cash flows here. All right, so it's basically the same function, but we're just going to use the balance sheet items to directly calculate the change in net working capital. So receivables, inventory, prepaid expenses, accounts payable, liabilities, accrued income tax. All right. So we'll calculate the change in net working capital starting with the current assets of the present year. It's going to be our receivables plus our inventories minus the current liabilities in the year. So current operating liabilities, accounts payable plus the accrued liability. Minus those same values in the previous year. So receivables, inventories, minus accounts payable and liabilities. All right, so that's going to get us to some different cash flows here. A couple of things I want to point out. Again, what we define as change in net working capital is at the discretion of the valuer. Right? Generally speaking, change in net working capital is change of current assets minus liabilities. But as you can note here, we didn't include some current assets and current liabilities. So the big one under current assets, cash holdings. Right? It's important for companies similar to people to have cash reserves on hand available for them if there's a liquidity crunch, if there's investment opportunity, anything available. But they're not necessarily directly tied to the operating performance of the company. Whereas receivables and inventory are directly tied to the operating performance of a company. With accounts receivable, companies aren't going to be making all of their sales on cash. They're going to be making some sales on credit basis. So receivables are directly related to the operations of a company. Inventories are also going to be directly related to the operating performance of a company, right? Especially when we're dealing with a retailer like Walmart. That inventory is the direct cause of revenue that the company is going to be generating. All right, lastly, we have prepaid expenses and other accounts, so basically miscellaneous cash flows. You can argue that prepaid expenses are directly associated with operating costs because these are just expenses already paid ahead of time that the company hasn't received the benefit for. So I think there is a decent case to make for that being a part of operating cash flow. But again, the total current assets that we're looking at for the company are not directly related to the operating cash flows. So go through your company when you're calculating cash flows and kind of think what makes sense to include on the operating side. Same thing with liabilities. So borrowings, right, any capital that's raised from a company is at management discretion. It's not directly tied to the operation. So when a company issues debt, it's because management chose to issue that debt. If a company chooses to repurchase equity or issue season equity offerings, it's at management discretion. It's not directly tied to the operations, right? So I would argue that the short-term borrowings, current portions of long-term debt that are going to show up here under current liabilities are not going to be directly tied to operations. On the flip side, accounts payable is directly tied to the operating performance. Right, this is the flip side of accounts receivable. So this is a product or service that the company has received for their production process, but it hasn't yet paid full in cash. Right, so accounts payable are directly tied. Accrued liabilities, similar aspect. So balances that the company has grown over time that it hasn't yet paid off, those may be directly tied to the operating performance. Income taxes. Right, those are going to affect our bottom line, but aren't directly necessarily tied to the operating performance. But taxes are going to be coming out when we're looking at the net of tax revenues and cost of revenues. So it's debatable. But like I mentioned, the capital expenses are usually not directly tied to the operating performance of the company. So that's why I excluded them for change in net working capital. All right, so when we're calculating free cash flow, it's a non-GAAP item. There's a lot of discretion that people have over applying this metric. And we've just looked at 3 measures of it here, right? The lazier method that Walmart uses, operating cash flow, net capital expenditures. The bottom-up approach that includes a little bit more information, right? So we start with our net income, add in our depreciation, net out CapEx, and change net working capital, right? So the difference here between these 2 methods are adding in depreciation, netting out change net working capital. And then there's our depreciation tax shield approach, which goes another step and shows that, yeah, depreciation is not a true cash outflow from a company, but it reduces a company's taxable income, right? So by reducing a company's taxable income, it's reducing the taxes that the company is paying. So it's effectively, the depreciation expense is effectively saving the company $3,600 in millions, right? So 3.6 billion, which is a substantial amount of money, right? So the depreciation tax shield method here, it includes a little bit more information, and more information is good for us, right? Most people, or most analysts, a lot of companies, they tend to gravitate towards the bottom-up approach. It's straightforward and easy to calculate, right? A couple additional steps to the laziest method that we've come across so far, but not as quite as informative as the depreciation tax shield. And as we can see, right, we have a different cash flow measure across these different metrics. All right, so at our discretion, we can choose what we think is the appropriate way to value companies, to value assets, but there's different amounts of information involved in each. One other thing I want to point out is the discretion on what's included in capital expenditures. So Walmart and a lot of analysts, they'll choose to purely look at capital expenditures, right? So payments for property, plant, and equipment. There can be an argument for including more or every item in the investing activities of the firm because they are actually tied to the cash operations that companies are going to be investing in, right? So great example, and what I included in our measure of CapEx here were proceeds from the disposal of assets, right? Companies don't just throw away their computers, their vehicles when they're done using them. They'll typically try to resell it, at least for scrap parts. Right, so once a project is over, even though an asset is at the end of its useful life, doesn't necessarily mean you can't get any cash outflows from disposing of that asset. So I included that in our capital expenditure. Right. And there's basically other versions of that included within the investing account on the cash flow statement. You can choose to include, exclude it. For the most part, analysts and companies will focus on this payments for property, plant, and equipment. All right, so we took one additional step in adding in the additional measure of CapEx. And so that's why when we look at Walmart's free cash flow measure in a little bit, we'll see that they arrived at a different capital expenditure account. Let me save this and get this uploaded. Any questions? Oh, yes. The free cash flow? No, not at this point. No. This is a general measure that you're going to be expected to understand and know working in the field because free cash flow is used to value assets. You had another question? Not at this point. In future versions of this class, I am going to be including these measures, yeah. But at this stage, no, you won't have to. I will tell you, though, that working in the field, you'll have to know how to calculate cash flows. It's one of the foundational measures of value that we use, including time value adjustments. So very important that you're familiar with calculating free cash flow and understand the major inputs to it, right? Especially, right, if you understand the depreciation tax shield method, it's the most complicated of the free cash flow approaches, but basically every other measure is a subset of this to a degree. So definitely recommend you go through and try to calculate these for your companies for your own benefit to try to understand how you could go about valuing assets. Right? And keep in mind, each step we're going here, there are some degrees of discretion. Excuse me. Right, so starting with the top line item, revenue, we're using the total revenues of the company, but technically they have net sales generated from producing or selling their goods and services, and then their membership income. Right, so there are some degrees of discretion. If you look at Capital IQ, they have a really good investment model. Let me get logged in real quick. Actually, they're not going to show it on. I'll have to send you the spreadsheet actually for it. But it's a good example of discretion of what's included. But in the baseline Capital IQ valuation model, they just use cost of goods sold instead of both cost of goods sold and selling general administrative for operating costs. Right. But now when we get in through depreciation, through change net working capital, that's where kind of the most discretion comes about, right? Are we going to use the bottom-up approach and just add back depreciation, or are we going to use the depreciation tax shield method, which reflects the net, the actual cash effect of the company? What are we going to include or exclude in our capital expenditures measures? Right? And same with change net working capital. There's lots of discretion over here, and you arrive at completely different measures of free cash flow depending on what you think is a relevant measure to be included in the free cash flow. Any other questions? Huh? I recommend you make the argument for it. Right? There are many different measures of value that we've come across. So use what you think is relevant and kind of discuss the pros and cons for each one. Yeah. And that's kind of what I want to try to get home for all of you to understand. There's a lot of discretion that we have here. Right? So people think of this field as everything is just factual bits of information, but really there's a lot of areas of gray on what is relevant, what's the appropriate way to actually measure something. Profit is one of them, right? We have different levels of profit. You can look at operating profit, net profit. You can translate it to free cash flow, which is how people in our field go about actually valuing assets, because it reflects the true change in cash being generated or destroyed. So there's lots of discretion and leeway for you to choose what is the appropriate measure. Any other questions? All right. So today we're actually just going to talk about management discussion and analysis. Oh, missed the up there. All right. So this is something that's found in 10K reports. We're going to be looking at Walmart's as our example in a little bit. And basically it just outlines how a company is performing. Right? So the 10K itself contains a lot of financial statements and information on how those financial statements are built up. And this just gives a little bit more context for the information provided in those financial statements. And it also might detail qualitative information that you might not explicitly see in the financial statements that are still relevant to the value of a company, right? The why behind some of the changes in the numbers. All right, so it gives us additional context for understanding the information that's laid out in financial statements. And that's always valuable to us in or outside of the company because it's just helping us understand the values that we're looking at. It also might outline right, some of the pros and cons that the company is dealing with, both in current markets and expected markets in the future. You might also find alternative measures of performance, and that's something that we're going to dig into, and it's something that often will result in companies measuring their free cash flow because, right, again, that's how we really measure value. All right, so these details are really good to provide from the side of both management and investors of a company. Right? So on the management side, they really have to consider what was the driving cause of change in the performance over time. Right? So looking at the financial statements, you can go through, do the cause of change analysis, and look at where exactly the changes occurred, but that won't necessarily give you the why on those changes occurred. Right? And so in management discussion analysis, MD&A, often what we're really trying to get at is the whys, right? What are the reasons for the increase in revenue, the increase in relative cost, or improvement over that time? Right? And so this is helpful for investors because it gives us basically better understanding of the statements that we're looking at. Right? We can look at the bottom line. We can go straight to the cash flows. That's usually where I start when analyzing a company. But this helps us backtrack a little bit to see what caused the changes that we're looking at when we're looking at a company's free cash flow. All right, so I'm going to pull up Walmart's 10K. All right, drop down to it. So there's a lot of information here, and I'll kind of just highlight what we're going to be looking at. All right, so it starts off with the general overview of the company, some major changes in their investments, as well as outlining how everything is going to proceed in this discussion. All right, so for this last step for individual section of the project, it's going to be important for you to go through and actually read what they're outlining here. And you'll note that there's basically two bits of information. There's the boilerplate sort of things that they're going to be talking about, right when you hear those kind of investment company ads and they follow up with all investments contain risk factors and you're going to be exposed to these risk factors should you choose to invest. It's your money, your responsibility. And there's basically just some degree of that in this MD&A, as all MDAs have. But it also includes a lot of valuable information, including motivations for why we're seeing changes in the company's performance. All right, so they're basically outlining what they look at when they're considering companies' performance. So growth, right? Companies are going to need increased revenue over time. Operating discipline, so managing their expenses. And investment, right? Capital allocation. In many ways, these make up the determinants of companies' performance over the long run, right? Companies need to be generating cash flow, so that's the top line item. Part of that cash flow generation is managing expenses, operating discipline, and capital allocation. Companies need to be making investments in value-adding projects over time. Otherwise, they're not going to be getting those cash inflows at the top. So it's starting off with discussing companies' growth over time. And one thing that you'll see broken out here is with fuel, and there's going to be some discussion on the impact of fuel to the company's growth. Right? So over this time period, there was significant inflation in gasoline prices. Right? So part of the reason that they have this aside, and as they note later on in a detail in their analysis, is basically inflation was a large determinant of their revenue growth over this time. Next, they bring up their operating discipline, right? So how were their costs controlled relative to their revenues being generated? Right? And over this time, they actually found that there was an increase in cost over this previous year. So why was there an increase in cost? And they detail that in this next line item, right? Operating expenses increased over this time, in part because of legal settlements that the company paid out additional money and restructuring businesses. Right? So now we're starting to get a better idea of what's going on. We saw that Walmart was less profitable despite having higher revenues. Right? Clearly, we see that revenues have increased over this time, but their costs proportionally increased more. So that resulted in lower net income. Still positive net income, but lower. All right, and now we're getting to the reason why this change occurred. Right? Part of the reasons why there was a legal settlement and restructuring of the company that resulted in higher operating costs. All right, so that's getting us a better idea on why the company was less profitable. They had these additional expenses that they were incurring. Strategic capital allocation. Right now, they're going to be discussing investments that they're making in club openings. All right, so it's a retailer. It needs stores in order to make those sales. They still make the vast majority of their sales in person locations. Right, so they detail what they're doing and what they're investing in, and this gives you an idea on where the company is prioritizing its money. Right, so for the most part, Walmart is an international company, but the vast majority of its resources are still focused in the U.S. Right, so it has an international presence, but primarily a U.S.-centric company. Right, so this gives us an idea on how the company is choosing to allocate its capital. It sees the U.S. as the broadest base of its market, and it's focusing its investments in this area. And this is an important consideration for companies, right? It's possible for companies to have grown to an extent that they're not capable of growing in a given market anymore, right? So one example that I heard an interesting news report about recently is Starbucks, right? Starbucks is everywhere, right? There's one, well, you can't see it from this classroom, it's right beyond those trees, right? But there's one right nearby. And they're making the argument that despite the prevalence of their stores, the lines at all of those stores are still so long that it's worth building more Starbucks for them to sell because people see those lines and they just turn around. I did that the other day. Funny enough, after hearing that story, there's a line at the Starbucks. I figured, I don't feel like waiting in that line. And I left, right? And that's the basic motivation for them to want to build more Starbucks build out is despite their prevalent location, there's still room for growth. And it's important to look at that sort of discussion. Is there room for the company to continue growing where it's currently operating, or should they consider changing, right? And Walmart's making the argument that there's still room for it to grow here in the US, but it is starting to make an international presence through international investments. All right, so keep that in mind when you're looking at your company. Where are they geographically located? Is there room for them to continue growing at the current rate for, right? How long can they continue growing for at that rate? And what are they doing to deal with the inevitable diminishing returns on investment in geographic locations where they've already built out as much as they can? All right, now we're going to start getting to some of the non-GAAP measures of how the company is gauging its performance. All right, so the first measures that they're providing here are return on assets and return on investment. Right, and they note here the differences on return on investment and return on assets that they're using that may make it a non-GAAP financial measure. Right, basically what they're doing is they're changing their measure of operating income. So operating income plus income, depreciation, amortization, and rent expense. Right, so to a degree, this is an operating cash flow measure. And rather than netting out CapEx and getting their next version of free cash flow, they're just netting out the rent expense that the company is facing. Right, so that's going to be their measure of operating income. And then they're going to be dividing that by total assets and investments that the company has made. Right, so return on assets reflect what is the bottom line income that the company is generating. Right, keep in mind they're using operating net income for their return on investment, but return on assets, they're using their net income divided by their average total assets over this time period to get the return on asset measure, right? And similar to us finding that the net income was lower relative to sales, we find a similar change 2022 to 2023. Their return on assets declined from 5.6 to 4.6%. And we find a similar change when we're looking at return on investment, right? They make their adjustment to operating cash flows. They start with the operating income, add an interest and depreciation and rent expenses. That brings us to our operating income. Dividing it by the average total assets plus they added in their depreciation and then some metrics for netting out change in, not change in working capital, change in current liabilities. That brings us to the return on investment, also declining from just under 15 to a little under 13% return on investment over this time. All right, so basically what they're saying is they think these metrics are relevant to the company's performance because it's reflective of their overall return on assets, which is a very commonly accepted measure of performance. Right, that's another way that we can gauge the performance of a company on a relative basis is what is their income relative to the assets that they're using to generate their revenues. Their measure of return on investment is as they already stated, a non-GAAP expense or non-GAAP item that they're using adjusting operating income to get their new version of operating cash flow, and divide it by the investments that the company is making over this time period. All right, and this brings us to how they're measuring free cash flow. Okay. This is a great way to reflect what free cash flow is trying to get, the ability to generate cash from our business operations. Right? That's why analysts measure free cash flow when we're trying to gauge the value of an asset. Cash flows are what we're concerned about. Right? But they define free cash flow as cash from operating activities minus CapEx, basically. Right? That lazy method that I had pointed out. So the argument for this is basically, right, these are the cash changes that are relevant for the company. That's basically the argument that they're making in here. Although they do take the time to point out that their measure of cash flow doesn't represent the residual cash flows that are available. In other words, it doesn't reflect the cash flows that investors and analysts will typically use when analyzing a company's performance. Right? And as we saw, when we make additional changes to this company's cash flows, it paints a little bit of a different picture for the operating performance of the firm. All right, so keep that in mind when you're looking at MD&A. Right, like I mentioned, typically management will do what they can to present their financial results and performance as positively as possible, including measures of performance that might reflect a more significant performance than was actually observed. Right. They also make the statement, right, many ways to calculate a company's cash flow. As I've already pointed out several times, this method is probably one of the worst measures of calculating free cash flow that's available. Right? It excludes a lot of relevant information like change in net working capital and depreciation, but it's what they're going with at this time. All right, so they mentioned their free cash flow still giving them significant operating cash flows available to them. All right, and now we're getting into some more details on what's going on with the company's revenues. All right, so let's see. All right. So the company's revenue increased. A lot of that they're attributing to increasing receipts, basically increasing the amount of sales per customer. But a lot of that is being driven by increases in food sales plus inflation of the goods being sold by Walmart. All right, so basically what this is saying is the revenue growth that we've seen over this time period, right, and there was significant revenue growth, an almost 7% increase in revenue. A lot of that was driven by inflation. Right? There was a mix of increased nominal sales, so more customer traffic, but much of it can be attributed to inflation over this time period. Right? So this is one of the things to keep an eye on as someone looking at a company's value. Companies might report or might have significant revenue growth. That's great. But it's important to dive into why exactly was that revenue growing. Right? If revenue is purely growing through inflationary pressure and that's it, that's not a great sign. Right? Companies need to be growing their revenue through a combination of increasing values and services, so increasing their revenues because they're able to increase their prices, or attracting more customers. Right? If their revenue growth is purely a function of inflationary pressure, that doesn't reflect any improvement in operating performance of the company. It just reflects the economic environment the company is operating in. So keep that in mind as you're going through management discussion and analysis. Try to dive into why exactly are those revenues increasing. If it's purely from inflation, that's not a great sign. What you want to look for is these increases in spending that customers are driven by, right? Increasing the number of customers coming in. Right, it brings up gross profit declining, right? And it brings us to some more information on why the costs increase. Right, so markdowns on merchandise. So basically, they had inventory on hand that they weren't able to sell, and higher supply chain costs. All right, so their inputs to their operating sales, the cost of those increased over this time period, and that's part of the reason we saw the increased costs. And lastly, just pure inflation. Right. So that inflationary pressure that's affecting those positive revenues is also affecting the expenses of the firm. Right? Again, just a mechanical increase in the cost inputs to the revenue generation. So not necessarily a reflection of poor or good performance. Right. And lastly, we have some more details on operating expenses. Right. The legal settlement that they mentioned earlier, the opioid-related settlement. I didn't realize this was something that Walmart was entangled in until I read through this. And they detail more information on this at the bottom of MD&A. And restructuring of businesses. Right. So the company's additional expenses are stemmed or are tied to increased pure operating costs, inflation, markdowns, so not being able to sell inventory that they had on hand, plus legal settlements and restructuring charges. All right, so now we found the company's revenue increased. The revenue increase was a mix of inflationary pressure plus increase in customer sales. However, this was offset by increases or proportionally higher increases in costs that were driven by not being able to sell inventory, higher supply chain costs, and inflation. Lastly, they had these more idiosyncratic costs that the company incurred of legal settlements and restructuring charges. Now we have a much better picture of what's going on with this company. Generated significantly more revenue. Part of that is attributable to inflation. Part of it is attributable to increase in sales. However, that increase in revenue was more than offset by the increase in costs, resulting in a lower net income over this time period. What caused those increase in costs? Right? Again, not being able to sell inventory, higher supply chain, and inflation. Right? And this is the information that we're trying to find when we're looking through MD&A. What actually caused the change? We can observe the change in financial statements, but that's not detailing to us necessarily the why on what resulted in that revenue growth. And so that's the value that we can get out of MD&A is just those additional motivating bits of information. Right. One of the last things they wrap up with is looking at different segment performance. Right. So it starts off with the domestic Walmart, right? So their largest retail presence. Then shows the international segment of Walmart. So again, it's a significant amount of revenues coming from there, but most of their operations are focused in the US, followed by their Sam's Club. All right, so it's breaking apart the different segments, and then you as an analyst can look what is reflecting the best performance over this time period. Right, so we see a 15% increase in sales at the Sam's Club. Operating income, though, only increased 2.3%. When we look at the international segment, revenue was basically flat, right? It rounded down to zero. However, operating income declined from 3.7 to 2.9%. And the domestic side, we see a 7% increase in revenues, but a decrease in operating income from 5.5 to 4.9%. All right, so the largest change in revenues was coming from Sam's Club. Is there some relevant thing going on here that's very important? Basically, what's going on here is they go into more detail. Sam's Club sells a lot of gas, right? If you have a membership there, they sell gas that's cheaper than typical gas stations nearby. And basically what they argue is this is due to a mix of higher ticket volume, so selling more goods, and higher inflation. Right, so basically just a reflection of what we've already seen, likely just more of an inflationary effect on this increase in revenue. Right, but this segment breakdown should be reflecting the major components of your company. Right, so does your company have a domestic and international component? Does it have different operating structures? Does it focus on government sales with one segment? Does it focus on education, consumer segments with others? So try to see what exactly those different segments are resulting in, and is there significant differences across those segments that maybe the company should focus more on one or divest from another or something like that. When the company turns to liquidity, right, basically they're just trying to see, are they capable of covering their costs, right? And what they're outlining here is their operating cash flows are sufficient to cover the company's costs, so they don't see any issue with their upcoming activities, right? So they explicitly outline, we're generating sufficient cash flow to cover operations. That's the state of being that most companies should strive to be if they're not already in. If companies are incapable of funding themselves through their operating cash flow, like we spoke about last time, that's not a good state to be in. Right? If you're dealing with a relatively young company, it might be expected that they're not at the stage to be able to fund themselves, so they're searching for external capital sources. But in general, companies should be able to fund themselves. Better if they're generating enough cash to also deal with their investment activities, right? If companies are generating sufficient cash to cover their investments, then they're not getting that additional capital cost from either raising further equity or issuing more debt that ties up the company's cash flows. And lastly, they have sufficient cash to pay out the dividends that they've already agreed to pay, and also engage in repurchase programs that they might be interested in. If you're dealing with a company that doesn't have a solid cash position, this is the place and the time for them to start discussing what actions are they considering to try to improve their operating conditions. Right? And so if you're dealing with an unprofitable company, it's important that you look through this section to see what changes are management working on making in order to have this company be able to fund itself, right? Especially funding itself through its operations. Right. Details use of cash in investing and financing. Right, that's kind of stuff that we can explicitly see just on the company's financial statements. Outlines whether the company is interested in purchasing stock from outstanding shareholders. Right, this doesn't change the value of the company. All it does is it changes how much cash is attributable to remaining shareholders. Right, when companies engage in share buybacks, they're not increasing the value of the company. They're just reducing the slices of pie that are distributable to shareholders. So, right, if you're looking at just as a simple breakdown, a company with a net or a cash flow of $100, and there's two shareholders, that's $50 to each shareholder. You buy back one of those shares for the remaining shareholder, they now have claim to $100 instead of $50. Same idea when we're scaling it up for large public companies. They're not changing the value of the firm. They're just using excess cash to increase the value claimable to each remaining shareholder. They get into some information about the long-term debt issuance, and notes the credit rating of the company and the motivation for what's their cost of capital going to be based on this credit rating. All right. This brings us to their miscellaneous section. Right. So they note if there's any accounting changes over this time period. I think they used some changes in LIFO at one point. Yep. Managing their inventories. So when you have a change in your accounting methods, that can result in changes in income over a given time period. So in this case, they had a change in LIFO, and that can result in a change in the cost accounting over a given time period. Right. And income taxes. Last little disclaimer here. All companies are going to be paying taxes. They are going to be net a company's cash flows and resulting in their free cash flow, so it is relevant. They're not necessarily a pure operating expense the company is going to be incurring. All right, so as you're going through your company's MD&A, keep things that are relevant in mind. Right? What is affecting the company's bottom line? Why are these changes occurring? What led to an increase in the revenue? What led to any changes in the company's costs? And try to think of the economic rationale behind that. Right? If a company's revenue increased purely through inflation, that increase in revenue doesn't necessarily mean the company is performing better. It just means the economic environment it's operating in changed. Right? If the company's income taxes decreased significantly, did that mean that they just had a one-off from the previous year where they had an accumulated income expense over this time period? Or is it the opposite? Is the current year, are they paying less in taxes for an abnormal reason? Right, so go through and think of the whys as you're looking at changes in the income statement. Right, when we're looking at the cause of change, why did revenue increase? When we're looking at the costs of the company, again, what resulted in those changing costs. When we broke down this cause of change, or it looked like cost of goods sold, debt, and miscellaneous were the reasons for Walmart's largest changes between 2022 and 2023. And MD&A kind of explained why. Right, so revenue did increase. We saw a 6.73% result in increase in net income because of this growth in revenue, but that was a mix of inflation and increased sales. The largest change was from an increase in the cost of goods sold, and they made the argument that inflation also affected their costs. They had purely higher input costs. They had inventory on hand that they weren't able to sell, so that was an expense, an increased expense over this time period, plus legal settlements. And I forget what that last cause was. Markdowns from selling a business. All right, so MD&A, it explicitly laid out why these costs increase: inflation, markdowns, stuff like that. All right, so when you're looking at your company, try to detail why exactly the changes occurred. Right, the cause of change analysis shows us the change. It doesn't give us the reason why. MD&A gives us that reason. Any questions on looking through MD&A? Okay. All right, so this is going to reflect the last step on your individual section of your project. So read through your company's MD&A. Keep in mind there are the boilerplate disclaimers that companies are going to make, and then there's the more materially relevant information that they're going to be including. Why did your company's revenue change? They're going to be talking about that. Why did the costs change? Again, they're going to be talking about that. Point out those causes. And keep in mind they're individual for each company, right? All companies in the U.S. were operating in an general inflationary environment. How did that affect their revenues? So go through and point that out. But yeah, MD&A has a lot of great information, the whys for what occurred, and a lot of analysts are going to look at that to try to build up their reports on a company on why exactly the performance changed in the way that we observed. All right, so that's going to be the last section for your project. And right, homework 3. So the first one is relatively straightforward. Just look at the total debt outstanding for the firm. You have your short and long-term portions. Was PepsiCo more profitable? Again, there are many metrics we can use to evaluate profit. You can look at the nominal level, but that's only a start. Always consider the relative performance relative to operating gross net profit relative to revenue. What does it look like when we change it to cash flow? There are many ways you can gauge a company's profitability. When you're looking at the cash flow statement, right, we have the direct method where they explicitly lay out the line items in terms of cash, and the bottom-up indirect method where they start from net income and net out the cash changes. So no, this is, I don't want to say a trick question, but again, just look up direct and indirect method for calculating your operating cash flow. And that should answer this part of the question. All right, so when we're dealing with GAAP measures, we should be arriving at the same result, everything else equal. Right, so when we're looking at a company's operating cash flows, the goal is to generate the same bottom line regardless of the method. Right, so when we're looking at the direct or indirect method, we should be getting the same operating cash flow either way. All right, cash flow from operating activities less than net income. All right, so this is again just asking you to dive into looking at the combination of revenues and expenses. What did that mix result in over the change in time period? And then lastly, look at the line items included in investing activities that should point out right, why there was a positive investing cash flow. Right, but in general, why should we see a positive investing cash flow? Right, usually investing cash flow reflects capital expenditures. All right, using Walmart as our example here. Usually investing cash flows are net cash outflows. What's the reason that we might observe a positive cash flow over a given time period from investments? This is just a general question, but answering it will point in the direction of answering the homework. Typically, cash flow from investing is negative because of capital expenditures. There are other items here, though, that result in cash inflows. So when would there be a net positive cash flow from investing based on these components in cash flows from investing? So this is reflecting the sum total here, right? Usually it is a negative value. Usually cash flow from investing is a net cash outflow of the firm. But it is possible for companies to have positive cash flow from investing. Where is that positive value coming? From a what? Not quite. Yes. Yeah. If a company has assets that they sell in excess of what they invested in, then you could have a positive cash inflow over the time period. Generally speaking, especially when you're dealing with a growing company, CapEx is going to outweigh the disposal of assets. But it's still possible to get a positive cash inflow from investing in a given year. All right? So you're going to have to look into see what might be going on in a company's investing cash flows that would result in a positive cash flow. All right, keep in mind, we're looking at Walmart here, but you're just going to have to apply this to the company that you're looking at, Pepsi. Any other questions?